Over the past 4 decades, U.S. federal debt as a percentage of GDP has been structurally rising but has been offset by lower and lower interest rates. As a result, overall interest expense has been rather contained. People who were concerned about the sustainability of the debt in the late 1980s and early 1990s were premature, and the resulting conclusion for many investors is that the debt doesn't matter. However, going forward, interest rates bumped into zero and are now trending structurally sideways to up as the government continues to increase its total debt outstanding. This means that interest expense will become an increasingly relevant part of the budget. Due to the recent increase in interest rates, the U.S. federal government's interest payments at $850 billion annualized have already exceeded what they spend on the military and continue to increase. Interest expense relative to GDP at 3.3% remains well below the high levels of 5% it reached in the 1980s, but is breaking out from a 2-decade low point. This time there is likely no escape valve. There is not another 4-decade period of steadily declining interest rates in front of us to offset the rising debts and deficits, and demographics are far worse now. Financial analyst and independent investor Alden shared her view on Twitter, where she commented on the U.S. Treasury updating their borrowing estimates even with low tax estimates. She also commented in a different tweet, "Liquidity tends to precede PMI a bit, and various measures of liquidity been turning up for a little while now. However, the question is how debt ceiling, TGA refill, and ongoing QT will affect liquidity this year." She said, "During periods where inflation runs at a notably higher pace than interest rates, it helps the debt-to-GDP ratio go down. The debt holders are effectively getting partially defaulted on through inflation when that happens. On the other hand, whenever the Federal Reserve tries to solidify the currency with positive inflation-adjusted rates, they'll notably increase the debt relative to GDP and substantially increase the interest expense on the debt. What compounds the problem is that hawkish monetary policy or improvements in the fiscal budget can dampen asset prices. The issue here is that U.S. federal tax receipts are highly correlated with asset prices. So as asset prices stagnate, tax receipts stagnate, and the deficit widens. According to data going back to 1960 by the U.S. Treasury, Congress has raised or suspended the debt ceiling 78 times, including 29 times under Democratic presidents and 49 times under Republican presidents. The reason it increases so much is because the government runs a deficit in most years, meaning that spending exceeds taxation and must be made up for with an increase in total debt outstanding. In 1917, the U.S. federal debt was approximately $5.7 billion. Today is approximately $31 trillion, which represents a nominal increase of over 5,000-fold in 106 years. Due to constant deficits, the government has to constantly issue new debt to pay off maturing debt. A handful of times in recent years, most notably in 2011, Congress has used the debt ceiling to pressure a presidential administration to either extract a bargain or for narrative gain, rather than to readily raise it. Often, when politicians oppose raising the debt ceiling, they do so within the narrative of fiscal constraint, but like many things these days, that is mostly political theater. The debt ceiling on its own is a separate concept from new spending authorization, although it can be combined into the same piece of legislation. Raising the debt ceiling itself doesn't authorize new spending. It merely allows the government to continue paying its previously authorized spending obligations. To not raise the debt ceiling means the government either has to not pay previously authorized spending obligations such as Social Security and Medicare, or must default on its national debt, which is accumulated over time from previously authorized spending obligations. In other words, logically speaking, the idea of fiscal constraint is relevant when deciding on new spending and taxation plans, but not relevant during debt ceiling disputes, which are about honoring prior spending plans. To promote fiscal constraint, politicians can vote against increases in spending, propose new legislation that reforms and reduces existing ongoing spending obligations, or propose changes to taxation and other revenue. Treasuries are used as leverage collateral by the Federal Reserve, the commercial banking system, foreign countries, and various other institutions. They are also held as savings assets by pensions, insurance companies, corporations, and individuals. Alden also commented on the bank crisis, stating in a tweet, "The largest banks have more cash liquidity relative to the size of their balance sheets than most other banks, so to the extent that various banks get acquired by the biggest ones, it extends the runway for which the Fed can do QT." She also tweeted a day prior that the reduction in money supply is due to a contraction in bank lending, but that's not the case. In her April economic newsletter, Alden commented that small temporary default would negatively impact the country's creditworthiness and negatively impact some individual entities that are temporarily defaulted on, while a large permanent default would heavily disrupt the entire system, since treasuries represent the leverage foundation that the system is built upon. The latter scenario of a large, permanent default is very unlikely, while the former scenario of a temporary default is reasonably possible, given how polarized politics have become and how large the debt and deficits are now. In her newsletter, she also talks about the aftermath of the debt ceiling and post-debt ceiling liquidity crunch. According to Alden, a very polarized legislation branch and executive branch have to figure out how to agree on a path forward with a non-zero chance that they temporarily default along the way before coming to some sort of reconciliation. But one way or another, they'll raise the debt ceiling after that whenever their political calculus and/or their monetary donors tells them it's necessary. However, financial markets aren't out of the woods then. At that point, the default problem turns into a liquidity problem. Since early 2022, the Federal Reserve has been doing quantitative tightening, meaning it is gradually destroying base money to rein in price inflation. This sucks liquidity out of the financial system and is usually negative for financial asset performance. They hit a speed bump in March 2023 due to the banking crisis, where the Federal Reserve had to provide loans to banks even as the Federal Reserve continued to destroy base money. They gave liquidity to the financial system with one hand while continuing to pull it out with the other, and the result was a net increase in liquidity, at least for a while. As of this writing, they continue to perform quantitative tightening, although the total balance sheet remains higher than the low point it reached in March 2023. However, since late September 2022, the Treasury General account has been drawing down as well. Unlike the Federal Reserve balance sheet, a drawdown in the Treasury General account is positive for financial system liquidity. When it draws down, it pushes liquidity back into the system that it had previously removed. They're now getting quite low compared to their desired target, absent a debt ceiling issue of $500 billion. Since September 2022, overall domestic liquidity has been rather flat, as the Federal Reserve and Treasury Department effectively offset each other. Risk assets have generally followed suit. The dollar index, a measure of the US dollar as a basket of other developed market currencies, peaked at the end of September 2022 and fell sharply from there. Since a lot of foreign countries and corporations have dollar-denominated debt, a drop in the dollar is generally positive for global liquidity. The cumulative result of this is that both domestic liquidity and global liquidity have been flat to positive from the end of September 2022 through this writing. During much of 2022, Alden said she had a negative view on liquidity, but once the debt ceiling impasse materialized in January 2023, she switched to a temporarily neutral view on liquidity and has been tracking that development. We've indeed been in that sideways liquidity situation, and the bank failures gave us a mild boost in liquidity in March. In a couple of months, however, we're set to enter that next phase, a potential negative double whammy for liquidity. Once the debt ceiling is resolved, the Treasury will be legally able to increase its general account back to its target level, which is negative for liquidity when it happens, as the Federal Reserve continues to pull liquidity out of the system, which is also negative for liquidity. The problem, however, is that bank cash levels as a percentage of bank assets are at pretty low levels in the post-2008 regulatory environment, especially for small banks. Sucking $500 billion of liquidity out of bank reserves to refill the Treasury General account might not be tenable and would likely be negative for financial assets. A background problem is that the U.S. government is running very large deficits. The U.S. federal government ran a $1.1 trillion deficit over the past 6 months and will continue to run large deficits going forward. The Federal Reserve is currently a net seller of treasuries. Most commercial banks aren't buying treasuries, and even the foreign sector in aggregate isn't currently buying treasuries. A total of 24 nations are now looking to build a strategic alliance that will challenge the U.S. dollar's decades-long role as the world's reserve currency. The group of 5 economically aligned countries, collectively known as BRICS, is reportedly on the cusp of a massive expansion. The core collection consists of Brazil, Russia, India, China, and South Africa, and a surge of nations interested in joining the alliance would bring the total number of nations to 24. The group of known newcomers includes Saudi Arabia, Iran, Argentina, the United Arab Emirates, Algeria, Egypt, Bahrain, and Indonesia, 2 unnamed nations from East Africa and 1 from West Africa. We are looking forward to the series of economic storms brewing on the horizon, from bank crisis to de-dollarization. If you enjoyed this video, make sure to give us a like, subscribe, and turn on notifications. Thanks for watching.